Hey guys! Fraudulent trading under Singapore's Insolvency Restructuring and Dissolution Act is a critical concept that every business owner and professional should understand. In simple layman terms, fraudulent trading happens when a company continues to conduct its business with the intent to defraud creditors or for any fraudulent purpose, especially when it is already insolvent or nearing insolvency. This means that if a company is unable to pay its debts but still racks up more debt without any genuine plan or ability to repay, it may be engaging in fraudulent trading. Think of it like someone maxing out their credit cards knowing they'll never repay the bank, except on a much larger corporate scale. The origins of fraudulent trading lie in common law principles that aim to hold directors accountable for their actions, particularly when companies go bankrupt and leave creditors empty-handed. The rationale behind this legal provision is to ensure that businesses operate transparently and responsibly. Directors and company officers should not be able to shield themselves behind a company's legal structure while engaging in deceitful practices that harm creditors, investors, and even employees. Section 238 of the Insolvency Act codifies this principle in Singapore, allowing courts to hold directors personally liable if they are found guilty of fraudulent trading. This acts as a strong deterrent, ensuring that individuals in charge of companies act in good faith, especially during financial distress. To better understand fraudulent trading, consider a few examples. In the first scenario, imagine a retail business struggling financially. The director knows the company is insolvent, but continues to order stock from suppliers, fully aware that the company has no realistic means of paying for the goods. He's hoping that some miracle, perhaps a sudden influx of cash or a big investor, will save the business. When that miracle doesn't come, the suppliers are left with unpaid invoices. This is a classic example of fraudulent trading, where the director knowingly incurred debt without any intention or ability to repay. In another scenario, think of a Ponzi scheme where a company uses money from new investors to pay off earlier investors rather than from legitimate profits. As more people invest, the scheme appears to thrive, but eventually it collapses when there aren't enough new investors to sustain it. The entire structure was built on deceit, with the company incurring obligations it could never fulfill. This is another form of fraudulent trading, as the company operated with an intent to defraud. A third example involves a construction company that takes deposits from clients to build homes, but uses those funds for purposes unrelated to the projects, perhaps paying off old debts or even funneling money into the director's personal accounts. When the company fails, the clients are left with incomplete homes and no way to recover their deposits. This is fraudulent trading combined with misappropriation, where the company took money under false pretenses and misused it. The consequences of engaging in fraudulent trading under Singapore law are severe. Directors or officers found guilty can be held personally liable for the company's debts, meaning that creditors can go after their personal assets to recover what they are owed. There are also criminal penalties, including fines and imprisonment, particularly in cases involving blatant fraud. Moreover, individuals found guilty may be disqualified from holding director positions in the future, further protecting the business ecosystem from repeat offenders. From a broader perspective, fraudulent trading laws are essential to maintaining trust in the market. Without such laws, dishonest directors could exploit the corporate structure to avoid accountability, leaving creditors and investors at significant risk. However, there's a delicate balance to strike. Not every business failure is fraudulent. Companies sometimes collapse despite the best efforts of honest directors. The law specifically targets situations where there is clear intent to deceive or reckless disregard for financial obligations. For directors, the key takeaway is to act responsibly and seek professional advice when the company faces financial trouble. Ignoring red flags or taking desperate risks can lead to personal liability and even criminal charges. For creditors and investors, it's a reminder to conduct thorough due diligence before extending credit or investing in businesses. especially in industries prone to financial volatility. Fraudulent trading provisions under the Insolvency Act serve a critical function in protecting creditors and maintaining the integrity of Singapore's business environment. They ensure that those in positions of power within companies are held accountable for their actions, especially when they knowingly place others at financial risk. Thanks for joining me in today's discussion. Don't forget to like, share, subscribe. I'll see you in the next video.